Would you like to own a slice of one of the best brands in the world? Want to take advantage of the kind of growth that only a world-class business can offer? Would you like to collect market-beating passive dividend income while you do so? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out, grow the channel, and I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing millions of consumers with a high quality, branded beverage experience. People usually have a choice to make. Do they spend their money on stuff or an experience? Well, this company offers both, and they do so in a unique way that has catapulted them to global leadership. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Starbucks Corporation, which appear to be trading at a significant discount today. Starbucks Corporation, stock ticker SBUX, is the world's leading retailer of high-quality specialty coffee products. These products are sold in 31,000 stores across 80 different markets, in addition to multi-channel retail. Company-owned stores accounted for approximately 81% of fiscal year 2019 revenue, while licensed stores accounted for approximately 11% of fiscal year 2019 revenue. The remainder was made up of other sales. The company splits its revenue across two primary geographical segments: Americas, approximately 69% of fiscal year 2019 revenue, and international, approximately 23%. Channel development, which is retail CPG, and corporate and other accounted for the remainder of revenue. When we talk about quality brands that are visible and trustworthy, there are few that come to mind faster than Starbucks. Millions of people flock to Starbucks every day because of their consistency and quality. They know exactly what they're going to get when they buy a product, and they also know their products are going to come with a standard of service. A Starbucks drink is an attainable luxury for everyone. That's what the brand tells you. In addition, Starbucks offers luxurious lounges in which to enjoy their products and services. Combining the coffee with the in-store experience means Starbucks is one of the rare companies that offers both a product and an experience that people around the world enjoy. In a world in which a lot of consumers have to choose between spending their money on stuff or experiences, Starbucks offers both. Because of the pandemic, lounge access is limited. This does reduce the company's experiential value proposition. That's not going to hurt Starbucks over the long run, though. The relentless focus on customer service puts them way ahead of the curve. They have traditional in-store purchases, drive-through options, mobile ordering, and delivery. The company's mastery of technology has allowed them to get their products in customers' hands while still offering the service they're known for. In addition, they put together a $7.15 billion licensing deal with Nestlé SA that saw them pay Starbucks for the right to exclusively sell the chain's packaged coffees and teas around the world. Starbucks now has Nestlé's global distribution might working for them, and it means that consumers everywhere are able to bypass stores altogether and still get their coffee fix. Keep in mind, too, that the lounge closures are temporary, yet you'd think this is a permanent move by looking at the drop in the stock price. That's simply not true. However, the stock market's emotional overreaction to these temporary issues has presented a great long-term opportunity on one of the highest quality brands you can possibly find. That quality carries over to the dividend, too. Starbucks has increased its dividend for 10 consecutive years with a 5-year dividend growth rate of 22.1%. That blistering growth comes on top of the stock's market-beating yield of 2.1%. This yield, by the way, is 50 basis points higher than the stock's 5-year average yield. And while the payout ratio at 146% looks extremely unsustainable, it's only so high because of the pandemic's temporary effects on the company's GAAP earnings. When things normalize, which will probably start to happen toward the end of this year, Starbucks will almost certainly go back to printing money again. For perspective, their payout ratio has historically been less than 50%. Their most recent dividend declaration came in at the end of June, showing no cut to the dividend. Starbucks is clearly committed to the dividend. That sends a great message to shareholders. Looking at business growth, the company increased its revenue from $10.707 billion in fiscal year 2010 to $26.508 billion in fiscal year 2019. That's a compound annual growth rate of 10.6%. I usually like to see mid-single-digit top-line growth from a mature business. Starbucks blew that out of the water. Meantime, earnings per share expanded from 62 cents to $2.92 over the same period, which is a compound annual growth rate of 18.79%. Just super impressive stuff here. Helping to propel some of that excess bottom line growth was share buybacks. Starbucks reduced its outstanding share count by almost 20% over the last decade. There was also an expansion of net margin, and the comps are remarkable. Global comparable store sales were up an amazing 5% for fiscal year 2019, and that's in a year in which they opened almost 2,000 new stores. 2020 will no doubt be tough for comps, margins, and just about every other metric. However, long-term investors should be thinking in terms of decades, not individual years. Looking forward, CFRA is projecting that Starbucks will compound its earnings per share at an annual rate of 14% over the next 3 years. I give CFRA full credit for putting up a number and going out on a limb, as it's so difficult right now to forecast anything. I think it's fair to say that 2020 will be ugly, but that might end up creating a bit of a coiled spring for Starbucks. It's pent-up demand. The company might have customers coming back in droves when the entire operation is running smoothly once again. Everyone I've personally spoken to is anxious to get back to normal life, which bodes well for Starbucks. CFRA notes a steep drop in revenue for fiscal year 2020, but they also see a very healthy rebound of 20% year-over-year revenue growth when looking out at fiscal year 2021. Again, there's a very real possibility of a coiled spring here in terms of demand and traffic. Regardless of what the company ends up actually doing over the next year or two, Starbucks is simply one of the best brands in the world when you're thinking about the next 10 to 20 years. When looking at long-term dividend growth, that easily sets them up for high single-digit dividend raises. Moving over to the balance sheet, the company maintains a rock-solid financial position. There has been some deterioration in the balance sheet in recent years, with Starbucks taking on debt to fuel extra shareholder returns, and the balance sheet looks worse than it really is due to negative equity. However, with slightly over $11 billion in long-term debt as of the end of last fiscal year, on a $90 billion market cap, Starbucks has no issues whatsoever with debt. Furthermore, the interest coverage ratio is north of 14. Profitability is very healthy, as one would expect for a world-class enterprise. Over the last 5 years, the company's average annual net margin of 14.47%. However, return on equity has become inapplicable because of the aforementioned negative shareholders' equity. It's worth noting that there's been a tremendous margin expansion story playing out here. Net margin was in the high single-digit range a decade ago. It's now routinely in the double digits. Overall, there's almost nothing to dislike about Starbucks as a long-term investment. With incredible brand value, economies of scale, a global distribution network, and a competent omni-channel strategy, Starbucks has durable competitive advantages. Of course, there are risks to consider. Regulation, competition, and litigation are omnipresent risks in every industry. Competition is arguably the biggest risk of those three. The industry is extremely competitive, although Starbucks does maintain enviable advantages over its competitors. There are volatile input costs at play, primarily in the form of labor and raw materials. Being a global company, they're exposed to macroeconomic issues and broad economic slowdowns. The pandemic has painfully highlighted this. Perhaps the biggest risk to long-term returns is the nature of the company itself. Their massive size means the law of large numbers will end up working against them at some point. With these risks known, I still think Starbucks is a fantastic long-term investment. That's particularly so when the valuation is so appealing. The stock's PE ratio of 70 isn't a useful metric right now. That's because sales and GAAP results are so far out of whack with the long-term reality of the business model. So you have to ask yourself whether or not you think Starbucks will be back to normal within 12 to 24 months. If you think the current situation is going to persist for decades to come, then Starbucks doesn't look cheap at all. However, I think life will return to normal more or less within the next year or so. It's interesting that the price-to-sales ratio at 3.8 is actually less than the stock's own 5-year average, and the yield, as noted earlier, is notably higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is at the top end of what I allow for usually when I use this analysis. If there's any company that deserves the benefit of the doubt though, it's this one. Starbucks is a true juggernaut. The commitment to the dividend is clear, the brand power is immense, and the dividend coverage under normal circumstances is excellent. I'd agree that this 8% looks generous over the next year or so, but when looking at the company's potential over the next few decades, I think this will average out nicely. The dividend discount model analysis gives me a fair value of $88.56. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Starbucks as a 4-star stock with a fair value estimate of $90. CFRA rates Starbucks as a 4-star buy with a 12-month target price of $90. I came out slightly low, but we have a pretty tight consensus here. Averaging the three numbers out gives us a final valuation of $89.52, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Starbucks Corporation is a global juggernaut with one of the most recognizable and powerful brands in the world. With a market-beating yield, a clear commitment to the dividend, strong long-term dividend growth, and the potential that shares are 15% undervalued, this looks like one of the best combinations of quality and value in the market today. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.